everyone. Welcome to Alpha Insights. I'm Brittany.
And I'm Kristen. Great to have you with us. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Today we're walking through how to analyze a stock for the long term. The practical stuff that actually matters when you want durable returns, not just headlines.
Exactly. We're talking business model first, then revenue quality, margins and returns, the balance sheet, and finally valuation. A checklist so you don't get fooled by one shiny number.
Start with the business model. Say in plain English how the company makes money, who the customers are, and what gives it an edge. Is the revenue one-off, subscription-based, or a platform cut?
Recurring revenue usually wins on predictability. Subscriptions, service contracts, that kind of thing. But transactional businesses can still be great if they have scale or a strong brand. Think Apple versus a big beverage company like Coca-Cola. Different profiles, different metrics to watch.
Okay, moving into revenue growth and quality. Not just how fast sales are growing, but what's driving that growth.
Right. Look at 3 to 5 years of trends and calculate compound growth to see the story. For example, if revenue moved from $280 billion to $350 billion over 2 years, the compound annual growth rate is about 11.8%. But beyond that, ask, is growth coming from more customers, higher prices, or one-time events?
I mean, when you look at the data, rising average revenue per user and improving retention are quality signals. Also, watch accounts receivable. If receivables grow faster than sales, that's a red flag on cash collection.
Right.
Next up, profitability. Break down gross margin, operating margin, and net margin. And then check return metrics like return on invested capital. These tell you how well the business turns sales into profit and whether management allocates capital wisely.
Exactly. A software company usually has high gross and operating margins because of scalability. Microsoft is a classic example. Whereas a heavy manufacturer with single-digit operating margins can still be fine if cash flow is steady and capital needs are low.
Now the balance sheet. Arguably the most boring, but also the most important part. Net debt, liquidity, and interest coverage tell you how safe a company is when markets tighten.
Say a company has $10 billion of total debt and $3 billion of cash. Net debt is $7 billion. If trailing EBITDA is $2.5 billion, net debt over EBITDA is about 2.8 times. That's moderate for many industries. But context matters.
Interest coverage is another must check. If earnings before interest and taxes divided by interest expense is below 2, analysts get worried. Above 4 or 5 is generally comfortable. And free cash flow, operating cash flow minus capital spending, is where the real durability shows up. So, the real question here is valuation. How much do you have to pay for the stream of cash a business will generate? Use multiple ratios: price to earnings, enterprise value to EBITDA, and price to book where relevant.
And put those multiples in context with growth and profitability. A high price to earnings can make sense if earnings are likely to grow fast and convert to cash. The PEG ratio, price to earnings divided by growth, can help relate valuation to expected growth. Around 1 suggests price and growth are roughly aligned.
Common mistakes people make: fixating on a single metric like P over E, ignoring industry norms, confusing accounting earnings with cash flow, and reacting to quarterly noise instead of multi-year trends.
Yeah, that's a good point. Also, don't ignore the balance sheet. High growth, funded by reckless leverage, can evaporate value quickly in a downturn.
Quick practical checklist you can use right away. 1. Describe the business model. 2. Check 3 to 5 years of revenue and recurring revenue percentage. 3. Review margins and return on invested capital. 4. Evaluate net debt and interest coverage. 5. Compare valuation multiples to peers and historicals.
And stress test it. Model a downside scenario to see if the company can service debt and keep investing. Honestly, I was a bit surprised by how often a recession scenario changes the story.
To wrap up the big takeaways. First, fundamentals start with the business model and then layer on growth quality, profitability, and balance sheet resilience.
Second, no single metric decides it. You need the checklist, industry context, and multi-year perspective. Third, valuation ties it together, but always relative to growth and cash flow quality.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything and we'll answer live. And while you're there, check out more market content and our Q&A feature.
Thanks for listening. We'll be back with more market breakdowns. Leave your questions at stockalpha.ai and keep sending us the topics you want us to unpack.
See you next time on Alpha Insights.